to today's session on consumer financing. It's great to see you here again. My name's Jessica Utiki. I'm the head of the Global Distributors Collective. This session is delivered in partnership with MAF Lab, Micro Asset Finance Lab, formerly known as PAYGo Lab. And it's supported by the UK government via the Transforming Energy Access platform. As always, please drop any questions that you've got as we go along in the chat. We're going to try and keep this session quite informal today, so also please do just raise your hand if you've got a question and jump in as we go along. There is a dedicated Q&A at the end, so if you don't manage to get your question asked during the chat bot or during the session, please feel free to use the time at the end to have any more questions answered. Please do keep your organization's name in brackets after your name in Zoom so we know who is in the room. And try and stay muted and without your camera on, just to minimize the amount of disturbance for our speakers and your fellow audience members today. So we've got about an hour together. It's quite a detailed and interesting topic. So let's get started. Here's what to expect today. First, I'll say a few words about what we know around GDC members offering consumer finance in the last mile distribution sector, which draws on findings from our latest State of the Sector report. We'll also have a few polls for you, so to get a better sense of the experience of those of you on the call today, I'll hand over to Willem Nolens, CEO of MAF Lab, who's going to dive more deeply into consumer financing in the last mile distribution space, specifically the pros and cons of providing it in-house versus via a third party, and how to build successful partnerships with an MFI if that's the route that you choose to go down. We'll also hear from GDC members with Energy. Unfortunately, Tulima Solar aren't able to join us today, but we've got Nuno from MAF Labs, who's also got a wealth of experience that will also be chipping in his absence. So next slide, please. So obviously, this is who you'll hear from. As I mentioned, we've got Willem Nolens, Managing Director of MAF Labs, Lilian Munizero, the CEO of WID Energy Africa, and unfortunately, we won't have Vincent on the call. So what we know is that around 72% of GDC members now offer consumer financing, but it's a tricky one to get right, and you need to invest in systems, working capital, and credit risk management. Many of our members, as you'll see from this graph, prefer to outsource this through partnerships with MFIs and SACCOs. This works well for higher value products, particularly those like a productive use of energy products, but it often excludes rural households. Loans are cash-based and they come with higher interest rates. Doesn't always allow for remote disconnection in case of default. So it's also not always available in your geographies. So in-house and PAYGo models, by contrast, are far more inclusive, but for all the reasons I mentioned at the start, it's quite tricky to get that right when you're running a last mile distribution company and not an asset financing company. That's why we're so pleased to kind of hear from the experts today and dive deeper into this topic with both Lillian and Willem and Nuno. So we're going to just put up a quick poll which will help with the framing. So I'd like to now turn over to you to get a better feel for your situation and previous experiences with providing credit to your customers. You should now see the poll up on your screen, so please do take a few minutes to read through the questions and respond as best you can. These questions are specifically designed for last mile distributors, so If you're joining today and you're not representing a last mile distribution company, please do not answer the questions. I'll now hand over to Willem Nolens from MAF Lab. He'll be able to dive into some of these topics and reflect on the poll results.
Jessica, one question, are you going to share the poll results?
Yes.
Hard for me to reflect on something
Here they are.
There you go. I was just leaving up a couple more seconds to see if anyone wanted to contribute. Can you see that? I have clicked share results. Can you see that, Willem?
Yeah, thank you. So it seems like there's a mixed bag in terms of who's offering credit, but the majority is doing in-house credit. That is clear. Then there's a very clear answer on that credit is really seen as a way to survive. That is unanimous, so that's very clear. And then on partnerships with financial institution, there is no one saying the partnership works well, and there's an equal number of people saying it works, but it's facing constraints and it's unsuccessful. And finally, if you offer credit in-house, again, a mixed bag. What you're doing. I'm very curious also to hear from the people who've said, I'm going really well. Please speak up and share. Feel free to share what you're doing so well, because it's you're an exception in the industry. And others say, well, it helps, but we struggle. And a few people have said, it is a disaster. Well, that's maybe a stark way of saying it, but this is the picture I think that we've also seen in most of the research we've done. Now, what I want to do today is basically look at two options for doing credit. One is doing it in-house. We will first look at that, and I will share some of the lessons we've learned. But we will also hear from Lily and from Nuno, and I hope from you, participants. Feel free to speak up, open your mic if you have any questions or you want to share something. That would really be appreciated. Second, I think it's important, if you look at credit, to realize that credit is not only pay as you go. Pay as you go. Many people right now are talking about pay as you go, but basically for this webinar, we will look at PAYGo, we will look at rent to own, leasing, hire purchase, fee for service, whatever name you give it. It is basically we're selling a product to the customer, and the customer is paying in bits and pieces. Now, fee for service, of course, is a little bit of an exceptional animal, because the customer actually basically continues to pay. There is never going to be any ownership, but still we consider it here for the purpose of this webinar. You can say, well, this is like credit. And you have in-house credit and out-house credit. As Jessica already mentioned, in-house credit, you're doing it yourself. You're using your own people to do a credit assessment to monitor the collections. And out-house credit means you have partnered with someone else, maybe a microfinance institution or a bank. So let's first look at in-house credit. And the question I'm going to to hopefully help with is a very simple overview of, okay, should you do it or not? And to many companies that we've spoken to, many people say, in-house credit is absolutely necessary. And you've just seen it in the poll that 100% of you have indicated, credit is really critical for us to sell our products, but not everyone is doing it. And even if you're doing it in-house or out-house, you're like having mixed experiences. Well, clearly, credit is important. It improves affordability, so you can simply reach more people. That is good for your impact, and it's good for your sales, obviously. You increase the demand simply because you make your product available to a wider customer audience. And because your demand increases, but in particular also because you can charge clients a higher price, you increase your sales margin. That all sounds music in our ears, doesn't it? We have more customers who per customer pay more. That is a win-win-win. However, many people have realized maybe a bit too late, but at least that credit is complex. And basically because of three reasons. You have a risk of default. Clients don't pay you. I think that is still a manageable risk, but a risk that many people have not foreseen is that doing credit in-house is extremely capital intensive. Simply because the customer's money is not coming in on the day of the sale, but it's coming in bits and pieces. Now, the problem that many companies have been experiencing doing credit is not so much that even people are defaulting, but that because of default, they ever need more cash, and they depend on external investors to survive because their business has become so capital intensive. And basically, you can say for a company who's offering credit, for instance, for 18 months or 2 years, your working capital cycle has increased from maybe 3 months, moment between the payment you make for your stock till the moment you have the cash back in your bank account. Normally, for a cash selling company, it is 2 to 3 months, depending on whether you buy locally or you ship in from abroad. But if you do credit, it can well be on average a year or even a year and a half if you have delays in customer payments. And that capital intensity is a massive risk that many people have not realized so much when they started doing credit. And finally, doing credit is also very costly. And I'll give you an example, but first of all, think of, everyone thinks, okay, why is it costly? Because I'm losing money, right? My customers are not all paying. Well, I think you will see that is actually a minor cost still compared to your refinancing cost, but especially compared to your operating expenses. And why are your operating expenses now going up so much? Not only because you need to do a credit assessment, with which many last mile distributors are doing, but not maybe good enough, because that leads to the risk of a default, of course, but also because once you have a defaulting portfolio, it is extremely hard to recover the money, and you need big call centers to call customers every day, sales agents to visit customers. You need to deploy recovery agents or recovery officers in the field, doing repossessions and visiting customers. So a lot of the costs are not so much actually in the default risk, but also in the fact that you are really have to monitor the portfolio. Maybe on the next slide I can give you a numeric example of that. So we have basically this is it's a real company. Of course, I've anonymized it and the numbers I've rounded off to make it a bit simpler. But we have a company here that is offering credit to its customers. The down payment, DP, is 10% and 18-month credit it offers. It's a bit of the average we see for instance, for solar systems or for some cooking solutions, e-mobility. Now, great, that company saw its demand increase by 10 times. From selling 100 products per month, they went to selling 1,000 products per month. That is huge, 10x increase simply because of credit. it shows the huge need for customers to pay and buy on credit. And my own experience is actually that customers are not only that you don't only allow customers to buy at a much lower cash out. It's also a way for customers to reduce risk. If you buy something on credit, people are not fooling you because you owe them. So there is an implicit warranty in the credit arrangement. That's all good news, right? The cost of goods sold for that company for each product was $60. The cash price was $100, so they made a margin, basically 40%. But hey, because they are now selling on credit, they can charge $140. So they saw their profit margin increase from $4,000, which is basically 40 times the $100 that they were selling before, to $80,000 per month. Huge, huge, huge increase, right? Because the margin went up from 60 to 140. That's $80 margin per product times 1,000 systems per month, $80,000 per month extra profit. Wow, that's really, really great. Now, of course, there is also some costs. The company realized that, but it's structurally underestimated what those costs would be. So we made a rough, and again, I've rounded off the numbers, but it is kind of supported by reputable companies like Gogla, organizations like Gogla and SMAP with recent numbers. First of all, the risk of default. A Gogla report, I think, which was based on 24 numbers, came to the conclusion that the average repayment rate in the industry is 72% at 2x loan tenor. At MAF Lab, we have 42 last mile distributors in our books, and we come to a pretty similar repayment rate of 72%. So meaning every $100 you lend out, 72 is repaid and 28 basically ultimately needs to be written off. Okay, that's a cost, right? But then the second cost and maybe risk is capital intense. This company started with only little capital, and they saw the profit margin and they went into credit full speed, but they didn't realize there's a huge fundraising need. So $1 million, they had never raised that amount of money, and the company was definitely not equipped to do it, because raising money to refinance your portfolio does not only require a lot of skills, but it's also it's a time process. You need to raise equity. You cannot forever raise debt. And it brings you in a very awkward position once you run out of stock and you see this company is selling 10 times more than before. When you run out of stock, it's a huge cost to each company because you still have to pay your people. Your sales agents start looking for other jobs, and while you're still fundraising. So a lot of basically companies offering credit have underestimated the importance of raising funding in time. Finally, the most interesting part is here to come, and these are numbers from SMAP. I can share the link with you to the report. They came, what's actually, if you look at the average price, and I think they had an average cost price or average retail selling price of $199 in their report. So what amount of that cost price consists of bad debt, cost of financing, and the operational cost? Now, 24% goes to bad debt. That is quite similar to the Gogla numbers. The cost of financing are 14%. For that system, it is $20. And the extra operational cost, meaning the difference between the operating expenses for a cash sale versus a credit sale, are approximately 12%, $17. So if you sum that up and you multiply that by 1,000 systems per month, you come to $71 times 1,000 is $71,000. That's the increasing cost every month. Now, this company still, you could say, is benefiting from doing credit because 80,000 is the extra margin. 71,000 is the extra cost. So you can say, well, the company is gaining 9,000 a month. Unfortunately, with many companies we've been seeing, it's different, right? Or they run into a stock out, which is a result of the capital intensiveness of the company, or they run into issues with the bad debt or the extra operational cost being higher than what is here. So it is important to realize this. And as I will come back to this later, I right now want to ask maybe Lily to come in and maybe Lily, for White Energy, I know you've been offering credit for already many years in-house. It would be great to hear from you how this information resonates with you and how you have been experiencing it over time, doing credit in-house in terms of benefits and cost.
Thanks, Willem. Am I audible?
Yeah, we can hear you.
Great. So I just hope that was not White Energy that you are describing, but everything resonates with me as White Energy. It's exactly the process that we've gone through. I would say that from a pay-as-you-go business model, the way we know it, or the way we knew it from the very beginning when it was introduced, let me be specific, in Zambia, from copying from the experience of East African countries like Kenya, Uganda, and Tanzania, the credit was already incorporated in the business model. There was not much knowledge on how to separate the two. It felt like it's pay-go, you give the credit, you recover, and so on and so forth. So the story of White Energy is similar to most of LMDs in the pay-go business, where the credit is inbuilt. And obviously, we liked saying from the time I was saying we focus on lending portfolio and distribution network, and it felt like it's a nice phrase, and that's what we do. But the cost there was a lot that was underlined and not seen. We played the role of a bank, basically providing loans to underserved communities in informal sector, dispersed location, as you were saying, with no collateral, high credit in a very volatile income region. So that was typical to us, typical to White Energy. So quite a number of funding were there, obviously, and they were available to support the pay-go companies. So there was, I have to mention something, maybe the form of grants that were available for many companies, especially small companies that were starting off. I'm talking about 2018, 2019, and the flexible financing as well. All that looked exactly like the option one that you are saying, that was seeing a profit of 80,000, but then it was good on paper as well. It was doable, but we were able to prove to increase the customer base. It grows, but so does the revenue growth. But as you mentioned, the portion of that revenue that is not recovered is high. It grows even higher as you increase your customer base. The time that is required for you to order for your products, since we are last mile distributors, we are not manufacturers, ordering the products in hard currency, on cash, selling them on credit in local currency, all that translates in exactly what you are explaining, how on paper it looks good, but in actual sense, it quickly becomes quite a nightmare. So that's exactly what I could say in few lines, but it's how the portfolio grows, how the repayment rate eventually drops, and you start experiencing the cash flow challenges, slowly defaulting on some of your lenders' obligations, and directly affecting the confidence that you have with your investors. And then it's right again. You need to raise, you need to sell, You need to scale. You need to catch up. Since I mentioned grants, you need to catch up with the disbursement that are attached to milestones that you need for your cash flow, for your payments, for your ordering a new stock. So it's a endless cycle from the beginning till the end, and that's exactly what you quickly realize, that it is capital intensive, that requires a lot of muscles, but mostly everything is based on your capabilities of raising the funds and managing the credit. It all really sits around the managing that credit.
Thank you very much, Lily. I'm just curious to hear from you how you have been, like you've like highlighted the risks and the struggles you've been having. I also know you've made at a certain point in time big changes to the way you're managing credit and booked quite
Yes.
successes. Could you also share a little bit of what you've done in order to reduce these costs, mainly of bad debt and the continuity risk of your fundraising?
Good. Yes. So really, the 4 years into our PAYGo, I think, yes, if I'm not mistaken, really about 4 years into it, we realized quickly that the repayment rate was killing us, the need to raising funds. And when we came across the PAYGo Lab, I have to say that when the portfolio had grown, repayment had dropped, and we adopted the PAYGo Lab system, and it improved our repayment rate to about 7%. That was from June 2022 into a year, June 2023, we could see the improvement in our repayment rate, about 7%. We adopted a better credit management system. We called it a wide 2.0. We had each customer agent directly responsible for the credit assessment and the credit approval of each loan, something that we're not doing in the 4 years earlier than that. Why? I could really pinpoint at one of the reasons why the credit assessment was not good. There was that race against raising more funds. There's that race against accumulating the customer base, ensuring that we reach the milestones. But we're not worried, we're not looking into what type of credit are we providing to these customers. Are we making them better off? Are they worse off than we found them because of the credit they've had to adopt? So we adopted the better credit management. Our customer care agents were in sync with the process. It actually extended to our sales agents. It was amazing that everybody was aligned and we saw the improvement. But obviously, if we are growing, you hit back the same challenges of raising funds. But at least it's a comfort knowing that you've improved your customer care, you've improved your customers, and there's that confidence that the customers have in what you are providing. But most importantly, I would say the sense of ownership that is installed in the team in the office, but most importantly, the team on the ground that now understand why they are actually spending hours looking for customers, for good customers that can improve the company's health, but also their repayment, because they are paid based on the good customers that they're bringing to the company. Sorry, I think you're still on mute, William.
You are on mute.
Excuse me. I just wanted to ask if there's any questions from the participants to Lily or me. I mean, we still have a few topics on in-house credit coming, but as this was really showing the pains that White Energy has had and how they've been able to solve it. This is so important. If there's any questions, please make yourself heard or drop it in the chat. Then Jessica will follow up. Maybe if we move in the meantime to the next slide, unless there is any. I wanted to show you basically, what are now if you're not doing credit yet, or you're considering maybe I'm not doing it well, I need to go back to the drawing board. What are the logical steps I think, you could consider? I think there's really, 5 steps, maybe 3 questions you need to ask yourself. Is it indeed true? So what is the multiplier on your customer demand? In the example I gave, it was 10 times. But recently, actually last week, there was a Gogla meeting and I met someone who actually said, no, we're not doing credit and we're actually selling pretty well because we're using carbon credits, or there was like, but there's different ways of doing it. Rotating schemes, you can do wholesale selling. So you really need to make sure, okay, is this like, what is the multiplier on your demand? And the way to do that typically is to just try it out in a small region. If you start credit, you don't need to do it for the whole country yet in which you're operating. You can start maybe doing one region and try it out there and see indeed, is the demand picking up? And number 2, will customers accept the higher price? We have seen more PAYGo companies actually charging too little for credit, cross-subsidizing basically their sale. So as I have shown you, doing credit is really costly, and it is not like it's not surprising that MFIs charge high interest rates. There is no reason why distributors who provide credit should charge lower interest rates, because in fact your costs are probably even higher than those MFIs. MFIs typically have default rates less than 5%. If you're doing 95% repayment in a microfinance institution, you're not doing a great job. In fact, if you're doing 90% or even worse, the central bank may audit you, right? They may say you're not doing it well. You're not protecting your customers well enough, just like Lily was alluding to. And then something else that Lily very clearly said: how will you ensure high repayment rate? This is something you need to learn. And many companies have indeed adopted a model which had credit and have assumed that the technology, the PAYGo, the remote shut-off or the token facility, would solve their credit risk. Well, we're now 15 years later and we can safely conclude that was a wrong assumption. Then other companies are saying, well, okay, it's maybe not, that's not enough, we agree. But we give a bonus to our sales agent if they do a proper job, or we correct them if they have too little payment in their portfolio. The problem is, and I think Lily also mentioned it, that your sales agents are not credit officers. They think different, they don't have the skills, and they are really, yes, if you've been convincing a customer for 1 hour in the burning sun, your mind just wants to sell that system, even if you know that customer is simply not going to pay. And you can give an incentive, but people will still sell, even if they don't, even because they don't want to be impolite to the customer. So if those 3 questions are answered through small pilots, you can recalculate your unit economics. Are you really going to make money on it? And then number 5, very important. If those unit economics work, you need to make sure you have funding, a lot of funding. You need to invest in fundraising. You need to absolutely have funders on board that say, well, if things go well, we will not give you only 500,000, we will give you 5 million. And if you have those kind of funders, you can really grow. But don't expand a credit business if your funding horizon the time you have basically till you run out of funding is less than 6 months. It's very tricky, and a lot of companies, probably also in the call today, have run into stockouts because they're not getting back the customer funding. That brings me to the final question or final slide, sorry, on in-house.
Willem. Oh,
Oh,
just
we've got a question from Richard Hansen for Lillian in the chat. Richard, I don't know if you want to unmute and ask your question to Lillian.
Yes, okay, I will ask the question verbally. Lillian, very good, your presentation. I wanted to get a sense on what your growth ambitions are and to get a sense of that, like what do you see that you have to reach in terms of scale? And then the other question that's directly related is, would your financial performance be better if scaling was not too aggressive? So it's kind of a balance, like how fast you want to grow or need to grow versus kind of keeping the company under control with regards to the quality of customers and collections and all.
Yes, thanks, Richard. I would say that scale, if you are not aggressive, if you do not need to scale that fast, it would make sense. But that implies that you are financially stable, that you have enough funding to allow to respond to your issues on the cash flow issues, but also the high cost of capital. So if you are, those are the biggest challenges. Remember, you are getting the bits and bits here and there from these customers that are paying on a weekly or monthly basis. Now, how do you grow, or how do you cater for your other operational costs with that little coming? So it only makes sense with the numbers. And the bigger you grow your portfolio is the only way that the PAYGo can make sense. So unless if you decide to cut a portion and make it a cash business, but not when it's PAYGo. I don't know if Willem maybe has a different sense of understanding this, but I believe once we go with the PAYGo, it only makes sense, financial sense, as you grow your customer base.
Yeah, I agree 100%, Lily. And I think, Richard, indeed, it is. I mean, this shows the trap, right? You're totally right. You should not grow that fast. Of course not. This is tricky business and you need to learn it. But the problem is that the moment that the warehouse is full with stock, your bank account is empty. You need to sell. So most of these companies are under huge pressure. And Lily already mentioned it. It is funding milestones. It is just the salaries need to be paid. You need to sell. And it's not like it's absolutely common sense to maximize the sales because else you cannot pay your bills. And again, I think now in hindsight, indeed, it is extremely important to do very proper planning and roll out pilots and do it in grow in a very controlled manner. But yeah, the reality is the cash flow problems are the biggest risk here, bigger even than default, I dare to say. Maybe moving to the next slide, Jessica. Basically, if you look at the big risks here, if you of doing credit in-house, there is undoubtedly a huge difference between short-term interest and long-term interest, and they conflict. And that is why many companies in high-income markets have stopped doing credit. I mean, retailers have stopped doing credit. If you would go to a supermarket to buy not a supermarket, warehouse to buy a fridge, you would always buy the fridge, and if you want credit, you would get the credit from a different financial institution, which normally also is regulated. So the short-term interests are normally prevailing over the long-term interest, and the short-term interests clearly are sales volume, sales margin, achieving targets to unlock new funding, sales incentives for sales teams, even for management teams. So there are some of the short-term incentives. And what I just mentioned and Lily mentioned, you need to pay your salaries. You need to make cash, and the only way to make cash is to sell more. At least you get the down payment, right? And so a lot of those companies are in the trap of thinking only short term. Well, in the long term, they realize, my customer protection, how can you talk about customer protection if you only collect 72% of the money? A lot of customers are in deep trouble because they have paid money and they've lost their system, or at least it's not functioning. Default or portfolio quality and financial sustainability, ultimately resulting in a lot of last mile distributors who had good products, good teams, have invested a lot of money in distribution and R&D, and have been broken because they started doing credit in a wrong way. Maybe I wanted to ask, maybe based on this slide, Nuno, you've been the managing director of SolarWorks in Mozambique for many years. Maybe you can share briefly how you look at the short term versus the long term. How has that affected you?
Thank you, Willem. Yes, it's true. So I've worked in Mozambique quite a lot. And as Lily was saying, we have also done some of the changes that Lily was speaking about. But the problem is that it took us a while to admit that we had a problem on the way we were doing credit. And that will take us to the short-term and the long-term objectives. In the beginning, we started making, internal changes without really understanding where the real problem was. We have changed stuff, commissions, prices. We have done everything before I met you and PAYGo Lab. But nothing really changed, nothing really improved. Just very briefly, we had customers we couldn't reach. Others were just not paying. The team was under pressure. So was I. And the reason was we had volumes to targets to meet, and results were not just coming. The turning point was when we decided to stop making excuses, stop pointing fingers to customers, and instead looking inward. And it's always difficult to. It's a balance that we need to find between the short-term objectives and the long-term objectives. And I really think as credit and sales, they are really difficult to balance. What we have done, we went back to basics. We made the effort to really understand customers, not just a quick check, but a proper assessment, so we could understand who they were and what they could afford. We also improved the way we explain our offer, and we finally admit we were not selling a product, we were providing loans. You all know that the onboarding process became longer than before, but it also became stronger. If I look back to 2020, 2022, and if I had the chance to externalize credit, even with all the improvements SolarWorks have made, I would have done that straight away. Why? Because the truth is, even when we got better at credit, that was never our strength. And if you think it's linked to what this slide it's about. I wanted the team to keep focus on what we were doing better, selling and servicing customers. And the overlap of running both sales operations and credit was one of the reasons, or maybe the main reason, why SolarWorks eventually had to shut down its operation in 2 countries. And even today, I'm still feeling the pain of it. So it's the way I see the PAYGo, mostly the PAYGo business as it is today. I don't really think the in-house credit it's possible. It's definitely not the right approach, because the risk, it's clear. We all need to sell, as you were saying. We have bills to pay. We are all under pressure to grow, to have better margins, to reach targets. But then at the same time, you need to protect your customers. You need to get to a more financial situation. So yeah, I'm not sure if I've answered the question, but I just wanted also to share a bit my experience and my pain, which I still feel it.
That's very clear, Nuno. Thank you for that. It is, I mean, I think, but it's also fair to say, well, if you look back at SolarWorks in Mozambique, you could also say, well, would there have been a financial institution to finance your customer? I think that might have been a problem in the rural areas, not?
Yeah, we have tried a lot, and you know that. I don't know how many MOUs we have signed in Mozambique with different MFIs, and none of them really worked, because they are SolarWorks. We were just selling mostly on rural areas. Customers that have no salary. They don't have bank accounts, they don't have credit history, and that it's not really a typical client for an MFI. So, and that was the main reason why all those partnerships, I think we have done 4 or 5 different partnerships, they have never worked, because an MFI wants a client that has a salary, that has a bank account, that has some credit history. None of our customers has that.
So we are now basically stuck. We don't want to do credit in-house, but there is also no credible alternative. Let's move to the next slide. I mean, we have concluded in this first section that PAYGo, or doing in-house credit, is tricky. You need an iron discipline to make sure you don't compromise, you don't live to the short-term incentives only. You need to combine short-term incentives with long-term discipline to do a good credit assessment, not to chase sales, to constantly focus on, exactly as Lillian brought it, exactly focus on good customer ownership, people owning their portfolio, not and people protecting the interest of the customer. But now let's look at MFI partnerships. Nuno has tried 4, I have tried 11 in my life, and I come to the same conclusion. Lily, I'm coming back to you later, and I hope some of you in the audience can also share experiences. How does it work? Can we make it work? I have not given up, because I'm seeing recently a few partnerships that start to work. Indeed, admittedly more in urban areas and more for higher up products. But I believe, and I start to believe, we've just been doing it wrong. So let's move to the next slide. There is a lot of partnerships that fail. Let's look at the reasons. Nuno already mentioned, those financial institutions or microfinance institutions, they focus on the urban, peri-urban areas. But my clients, they were in rural Mozambique. So, you can try and sign an MOU the MOU goes to the branch of the MFI, and people say, but those people are way too far. But also, Nuno mentioned, our systems were maybe $100, maybe $150 equivalent. MFIs typically look at the minimum of 500. There is exceptions, even some like Breck and Asha doing smaller loans, at least the initial loan, but they don't do asset finance. They really focus on group lending, and it's a different product altogether. So, that's a hard one, but there is exceptions there. I'll explain it to you in a minute. Then a lot of reason is because the MFI simply does not trust you so much. Who is that distributor? What's the quality of the product? Is it like e-mobility? Is it cooking? Is it solar? They don't trust it. And they fear complexity. Because indeed, if you partner with an MFI, what happens if the product doesn't work and the customer is not paying? What happens if a product needs to be repossessed? How does the buyback work? A lot of the partnerships I have seen were actually not credit partnerships. They were sales partnerships. The last mile distributor basically wanted to sell to MFI customers. But that is not the partnership we are having in mind here. If you really want to make this work, you should bring customers to the MFI, and the MFI can then finance it. So rather than taking their customers, which a lot of the partnerships that at least I have seen have failed because of just the fact that the initial goal of the partnership was not aligned. And finally, and probably most important, the last mile distributor doesn't want it, simply because there might be more rejections coming. Because the MFI may say, well, we cannot approve a customer within 5 minutes. We need 24 hours for that. If you're lucky, some say maybe 3 days or 7 days, right? They may also say, well, a down payment of 4% or 5%. We don't accept that. We want 20%. And yes, it is true. That will eat into your sales. But maybe anyway, those customers that you're approving right now might give you more sales, but they're also the customers that are defaulting. So those MFIs have learned how to do credit for 25 plus years. And I think we should look at them and accept the fact that they are going to reject a few customers. In fact, we have done a few pilots where we have both been seeing pilots with outsourcing credit and also companies that have really adopted like very strict credit management, doing extensive credit assessments on the customer when they would come in, increasing their down payment, having a shorter loan tenor, not 36 months like we have seen in some countries, but 18 months for a first loan max. And in fact, what we have seen is that those companies indeed lost sales in the first 2-3 months. But then everyone says, well, that's the new reality. The sales agents started already focusing on a different type of customers. So within 2-3 months, actually sales started to stabilize. And in fact, after 6 months, they were higher than ever before. Why? Because investors suddenly saw the improved repayment rates, and they started disbursing money again to the company. So ultimately, access to funding can only improve if your repayment rate goes up, and the two things are extremely linked. Maybe before I go to please, Jessica.
Sorry to cut it. We've only got a few minutes left, so it'd be great maybe if you could wrap up your points, and we can see if there are any final questions. Sorry, Willem, I know it's very compelling.
No, it's good that you say that, because this is a topic we can. Please go to the last slide, and then I want to hand over to also I want to ask Lily. I mean, these are and I'm sure Jessica and Charlotte will share the presentation. So these are the 5 steps that we believe can lead to successful MFI partnership, really aligning on customer segment and eligibility. And this is not a process where the last mile distributor, to be very honest with you, has a lot of negotiation power. Please listen to the MFI, see what they want, see what they think. Trust them. They are not fools. Then second, agree on loan products and ticket sizes. if indeed the MFI is anyway doing only anything above $500, you can push for your $150 systems, but they're not going to do it. Then an SLA, a service level agreement, that needs to be super solid and have absolute aligned expectations. We're always happy to help if you would want some guidance there. Align on expectations on credit decisions. So really, like, there will be rejections. Let's learn from it, but let's not start criticizing the MFI for it. They know what they're doing, just as we know what we are doing. But it's, as Nuno said, they are the experts, not us. And then, and I think that brings us also back to the first question that was asked. Pilot it. You don't need to roll it out for the whole country or for all your operations yet. Just start small, learn from it, and then scale. Lily, maybe I wanted to ask you a final question, unless there's any questions from the audience, but just keen to hear from you how you have experienced doing. Have you tried it? And if not, why not? And if so, what happened?
So straightforward, we haven't tried it. We've tried some partnerships with the banks and MFIs, but in the sense that we are the ones doing the looking for the customers and ensuring that, and it did not work, simply because locally the MFIs will not understand the business and they have no confidence, especially looking at the repayment rates. So maybe it's something with the knowledge and that can change in how the MFIs and the companies would work in partnership. I'll come back to asking you the question. If you are the MFI and you have a company like Wide Energy that does last mile distribution, would you invest in that? Would you provide that credit facility? And what would you base yourself on? Let's say this is a company with no history, basically.
That's a great question. We are doing exactly this right now with an MFI in Somalia. The answer we got is we will do the credit exactly as we are doing credit for our cash clients. So whether it's a solar system we're financing, or like a trader wanting more inventory, or some consumer wanting some cash to buy an asset, we don't care. We don't want to structure a separate loan product for like a partner last mile distributor. So let us do our work. We can do it. You can forward your customer applications to us. No need for the sales agent to even do a credit assessment. We will do that ourselves. But as don't try to negotiate a special position, because that's what MFIs are allergic for. They don't, because immediately they will see, oops, this is going to be a higher risk customer category. And that doesn't fit in what they are so good at. What they are so good at is standardization. So as long as our product, our like financial product fits in their standardized approach, we're going to convince them. And we need to make it super simple for them and start small. I think those are the three things that I would answer if I would be an MFI.
Great. Let's do business.
Thanks, Lillian. We are at time, but if you've got time, Willem and Lillian, we're happy to stay online for anyone who can stay a little bit extra to ask any additional questions. Is that good for you, Willem?
Of course.
We have actually got a question from Richard Hansen in the chat. I don't know, Richard, if you want to unmute again and ask the question.
Sure, I'd be glad to ask it. Willem, we've had experience pursuing, MFI partnership going way back. Been in the business for a long time. We're based in Central America, in Honduras, so it's not the sub-Saharan African market. But I wanted to ask if you've had a problem, or maybe it's too early to determine, but have you had a problem with MFI agents giving the sale to a PAYGo competitor, especially if that competitor pays the MFI agent, not at a high level in the organization, but the agent that's out there offering credit in a certain particular area, then the other PAYGo company, pays a bribe so that they can get the customer. Have you seen that problem? We had that problem in Honduras. It's basically dirty business, but so there was an issue of really being able to have a tight system with faithful compliance. And I don't know whether that's come up. It may come up over time as you go forward with this, or maybe it's only characteristic to Central America and the level of corruption that kind of runs up and down the system. But
I've seen the problem with actually our own sales agents. So I was managing a solar company in Uganda where our own sales agents would sometimes decide whom they would give the sale to. Well, we were really under the impression they were our sales agents. But interestingly enough, if you look at the MFI model, for these very rural customers, right now the model we are seeing, at least in some countries in sub-Saharan Africa, is that the MFI would not go to visit a customer physically. They will depend on phone calls with the customer, with the customer's spouse, with references, maybe a guarantor, and then depend also on other information that is currently more available than in the past. That reduces their operating expenses tremendously, and therefore they can do loans in the $100 to $300 range. But that also means they don't have staff on the ground. They will depend on the company, on the distributor. And that's why this problem, in that model at least, would not be there, right? Because there is no physical. The downside, of course, is that the MFI for repossessions will be dependent on the sales company. The way to solve that is that you, in the contract with the sales company, you have like a retainer where you retain part of basically the disbursed money to cater for losses because of areas where last mile distributor agents are, for instance, not servicing the customer or not able to do a repossession, for instance. So there's a way to mitigate that risk, but ideally, no, I would not see that risk so much. And I also would always feel that the last mile distributor, they are the sellers. They are the ones going out, knocking on doors. And just if the customer says, well, I love your product, it is $200, I cannot afford it. They could over time even have 2 or 3 cards of MFIs or asset finance, micro asset finance companies that they can call, right? Here's 2 or 3 companies you can call. You can have a loan tomorrow. And they're like competing with each other. And that should be I know this is like maybe still going to take 5 to 10 years, but this is the world we should envision, because that is where customers are protected much better, because those financial institutions are regulated. They have interest rate caps. They cannot screw up with customer protection, just like MFIs. It's better organized than in other parts of the world in sub-Saharan Africa.
Excuse me. Yeah. Well, I think this is great work that you're doing. You're pursuing in this area to really get it, figured out and determine kind of the variations that occur as you build these partnerships. I applaud that. In our structure, it's a little bit different the way we look at it, because we look at 2 specific types of capital that are needed. One is the working capital required for inventory to maintain stock. And then the other capital is specifically the customer lending capital, which we crowd lend from Kiva. So in the Kiva structure, you really have to determine if your customer, you have to have an application for the customers. We really have followed an MFI approach since we started many years ago. And so like our credit manager came from the MFI sector, worked for Finca for, and a couple other organizations for like 15 years. So we basically have a credit department.
Yep.
Those incentives are related to high collection rates. Also, our sales persons end up getting their commission is cash flow from the customer. So they've got a portfolio of customers and they get their commission when the cash comes in, as opposed to they make a sale, they make their commission. So it's all kind of aligned in that way, which is a unique case. And I mean, we're in a setting where I don't believe the MFI sector in these remote areas, because we're into the very last mile in Central America. It's very remote customers. So it may not be applicable. And I just applaud the work you're doing to really figure this out. It is critical. but our collection rates are well over 95%. But we aren't super aggressive, and in fact, we're not a PAYGo company. We're a solar equipment company, and we do PAYGo though, and we have like on Gaza with Sun King, and the kits and PAYGo, but it's not our whole business. So we also sell on a cash basis, and in addition to off-grid solar, we do grid tied in urban areas. So it's a different mix to keep our company going. But I definitely applaud the work you're doing, and we're proud members of the Distributor Collective, and share wherever we can. Although it's a different marketplace. I mean, the epicenter of energy access is really sub-Saharan Africa, and I've been working in Latin America for decades. So
great.
yeah.
And if you would say, like your credit, the discipline you have brought in the organization to maintain high credit, I mean, that's really exceptional. Was it like the fact that you brought in an experienced credit manager? Was it like that you yourself had the discipline not to compromise on credit terms to boost your market demand? What would you say were?
Well, when I got into the business, when I got into the solar business, I realized that customers needed credit. So I actually studied the MFI sector when I was getting into it. So I kind of understood the need for credit to people who were, low income, and, the issues of financing, that they wouldn't be able to go to a bank. And so kind of looked at the MFI sector, did do some partnership work with MFIs, and original work that I did assisting even some what were at the time NGO credit programs, because the regulated MFIs did not exist. I'm talking about, even the 1980s, because basically introduced photovoltaics in the Dominican Republic in the 1980s, and then started a company in Honduras after kind of replicating over there. We did do some tie-ins, but they were primarily NGOs with credit programs, and then they evolved to become MFIs that were regulated. But at that point, then they had to meet their goals, and they stayed primarily urban and really couldn't reach those rural areas. So we pretty much had to develop our own program, but it was pretty much modeled upon really understanding MFIs from the study that I did on MFIs and determining who was who. But there was a World Bank project called ProSol, started in 2007, and it obligated that they brought in MFIs, and they tried to use that model in part because of the work the World Bank did studying my early work with some engagement on microfinance. And what they did is they tried to take away our financing capability and only have the MFIs to do that. But those MFIs stayed in the business because they were getting subsidies. So basically, there were subsidies. The World Bank project kind of supported the MFIs to get involved. And when that project went away, then they didn't really stay in the business. And the companies were not getting any grants. So the MFIs were getting grants. So we didn't have the luxury as well of grants as the sub-Saharan Africa, PAYGo companies. It's a very different kind of history and kind of how things have evolved. And we're down to the final percentage in Honduras. It's the final 15% of the country's population. It's about 30% of the rural population. We're definitely very last mile, really trying to get universal access the best we can. But I don't want to take too much of the time on the screen here. But if anybody wants to contact me, other members in any regard, I'm not sure how applicable it all is to sub-Saharan Africa. My work in Africa is limited.
Well, I believe it is very relevant. And it's encouraging to hear. And one of the risks we're seeing right now, indeed, in East Africa, or in actually all of sub-Saharan Africa, is the influx of huge end user subsidy programs, which are inevitably going to focus more on sales volumes. So while it contributes to affordability, which is great, right? But there will also be some race to the bottom inevitably. And I think it's great to hear from you that indeed the absence of such incentive programs has helped you to just establish a disciplined, well-functioning credit business. I know you're not.
We also sell on a cash basis. There's a percentage of customers when they sell a cow or some other couple of animals, or they get us some cash. There's also remittances, a lot of remittances from the United States and Central America. So we do have cash customers. So it's not it'd be very limited if we were limited to cash. So the credit does expand our business quite a bit, and it's very useful for kind of the universal access goal. Try and reach more or less everybody in our region. But we did structure, our company is structured with a credit department. We do have a solar product. We know we have a financial product. We've known that all along. It's like, that's a financial product, and did hire somebody in the sector. So that kind of structure, that discipline has been helpful. We don't just finance everybody. They have to apply. And so, I think that aspect, for those of the companies that find they do need to keep it in-house, then there's probably some aspects of what we're doing that might be useful in terms of including the incentives, how you incentivize the employees, both on the credit side and the sales installers that are installing equipment. So I'm glad to share. As Willem, if you want to stay in touch, we're very
definitely
glad to collaborate.
In conclusion, having looked at 42 PAYGo companies and having managed MFIs and PAYGo companies in the past as well myself, my conclusion is yes, it can be done in-house, Richard, and all participants. But I think it's no magic, right? But what you're saying, what you're just saying, is 100% resonates with me. You need to internally separate it as if you're managing two companies. And if you manage to do that, and if you really manage to have a wall in between, where not like at the last day of the month, all the salespeople are jumping into the credit room to say, approve, right? We need to achieve our targets. But if you really make sure there are two physically separated teams and even like ideally companies with their own P&L, their own managers, I think that's the way to go. Indeed, in the absence of specialized financial institutions for your target group.
Well, this is what's evolved in Latin America. Is you've got companies that sell appliances and they provide financing. A company like Electra out of Mexico that also operates in Central America. It's called Electra. Oh, they always offered financing, and then they got to a point where they spun off what's called Azteca. So they are a financing company now, and so they getting a lot of experience. So those are separate legal entities, but they're in the same group. So I agree with what you're saying. And if there was probably a larger market where we are, we might spin off our credit department to become a separate legal entity. But our markets are a lot more limited than the sub-Saharan African markets in terms of the off-grid populations. So,
thank you so much for your contribution, and that's the way to go indeed. Any other questions or comments from anyone?
Nothing further in the chat. No, nothing further in the chat. But if anyone does have a final question, feel free to just unmute and chip in. Otherwise, I think Jess will wrap up and we'll say goodbye.
Yeah, thank you, everyone. Thanks, Willem and Lillian, for the really engaging talk. And thanks for the participants for staying on a bit longer. I think it was well worth keeping the webinar open for that bit longer. So just as a wrap up, you'll see now the feedback poll in front of you. We'd really appreciate if you could fill that out, just so we can always keep improving our webinars and processes. We will share these slides, the recording, and the contact detail of today's speakers. So if there was something you missed or you wanted just to recap, all the resources will be available. And that's the last GDC webinar of the year. We'll see you in 2026 for much more. And in the meantime, really wishing everyone who celebrates and those who don't a festive period. I hope that you'll get some well-deserved rest. And yeah, we'll see you in 2026. Thank you, everyone.
Thank you.
Thank you. Thanks, everyone.
Thank you.